Hey guys, welcome to this video. Today I'm going to be showing you how the world's biggest hedge fund, also known as Bridgewater Associates, how they invest. And I'm going to be showing you guys their advice for investors on how to invest in the current economic climate. In this video, I'm going to show you guys what Bridgewater's portfolio looks like and how it's recently changed. And there have been some pretty huge changes which can give investors clues on to how to invest. And towards the end of this video, I'm going to be showing you guys how you can actually implement the strategy that Bridgewater uses so that you can become a better investor and be better prepared for different economic environments. If you guys could do me a favor, scroll down and smash the like button so more people can learn how the world's best hedge fund invests and maybe actually implement their strategies in their own portfolio. And if you're new, you might as well also just hit that subscribe button. Bridgewater Associates is the world's largest hedge fund and they manage around $160 billion. Bridgewater is a macro hedge fund. That means that they look at the global economy and they see which way it's going and they invest based upon that. According to them, understanding how the world and the economy works is the single most important thing for them when determining how to invest. They need to understand the cycles of the economy and quantify it so they can determine what assets and what things to invest in. Their founder started the hedge fund in 1975 and his name is Ray Dalio. You should be thanking Ray Dalio and Bridgewater Associates because they are one of the main reasons why McDonald's even launched the Chicken McNugget. They also do have a bunch of different investing strategies that has made them quite famous over the years. One of these strategies is called their all-weather portfolio. Ray Dalio and Bridgewater identified and created this portfolio by asking the question of what kind of portfolio would you want that would perform well across all different environments. Essentially, it's meant to be sort of a permanent portfolio that allows you just to put your money in this portfolio and it will grow at a reasonable pace. The all-weather portfolio is meant to give you safety. You're not going to get the best returns in the world, but there'll be a lot less fluctuations in your portfolio. For example, the biggest drawdown, which is the largest decrease that this portfolio has ever seen, is around 12% in 2009. A regular stock portfolio had almost a 40% decrease in 2009. The strategy of this portfolio is to combine a bunch of different assets like gold, stocks, and bonds that perform well in different environments. When one is increasing, the other might be staying the same or decreasing. So for example, if stocks go down, bonds on the other hand will go up and so will gold. The different assets in the portfolio balance each other out and that's why you're going to see less declines by using this portfolio. The all-weather portfolio is meant to do well in all different expectations of the market, whether growth is rising or falling or prices are rising or falling. On the top of the box, we can see growth and inflation, and then we can see market expectations of rising or falling. The second image shows you what assets do well in these different environments. When the economy is growing, stocks tend to do well, and so does the debt of various companies in emerging markets. If there's inflation in the US, inflation-linked bonds, which are bonds that give you a better return if there's more inflation because they're linked to inflation, perform well. So do commodities such as gold. When there is slowing growth or falling growth in the economy, bonds tend to do well. And finally, when inflation is falling or when there's potentially deflation, which is decreasing prices, or low inflation in general, equities tend to do well as bonds tend to do well. So the idea of this portfolio is to have an allocation of bonds, inflation-linked bonds, commodities, and stocks so that regardless of what economic situation you're in, your portfolio will perform relatively well. It will allow your portfolio to not experience as many dips as you would have if you were just in 100% stocks, because if there was a recession, the stocks would go down a lot more, but the commodities and the bonds would push your portfolio up so the overall decrease wouldn't be as bad. The magnitude of your decreases will be a lot less. What that means is just instead of seeing maybe a 40% decrease, you'll only see around a 10% decrease. However, over the long term, stocks tend to perform the best, so by including these other assets, your portfolio's overall total returns won't be as good, but over the time you'll see less fluctuations and less decreases. And the reason why this portfolio is so good is because it allows you to manage your emotions better. If you see a 40% decrease, you might be scared and sell your stocks, for example. However, if you're only seeing a 10% decrease, that is something that you can handle and you know that you won't sell any of your positions in a recession, which would greatly hurt your returns. Based on interviews conducted with Tony Robbins and Ray Dalio, this is what Ray Dalio has said that the portfolio could potentially look like. So you have 30% in stocks, 40% in long-term bonds. Long-term bonds are just bonds that have a duration greater than 10 years. You then have 15% in intermediate bonds, which are bonds that have a duration of around 2 to 10 years. And then you have 7.5% in gold and 7.5% in commodities. And so this is what the all-weather portfolio looks like. And you can implement it if you're in the US by using some of these ETFs. So this portfolio is reasonably easy to implement. One thing that I haven't really seen people mention when talking about the all-weather portfolio is that even though, yes, this is the original asset allocation of around 30% stocks, 55% bonds, and then around 15% commodities, This portfolio can change over time, and as we can see, in April 2009, when the stock market was in such a terrible position and the global financial crisis was occurring, the all-weather portfolio actually went into safe portfolio mode, which essentially means that they got rid of their equities, emerging market debt, and commodities, and the whole portfolio was mainly nominal and inflation-linked bonds as well as gold. If you were investing with Bridgewater, they would potentially change this all-weather portfolio over time. However, as an individual investor, you would not obviously know when they are changing this portfolio, and that's not information we have. That is just something to be aware of. Even though Ray Dalio has said that this is what the portfolio will look like, when he's actually implementing this portfolio for clients, it can potentially change over time. Luckily for us, Bridgewater does have a YouTube channel where they post videos. I've watched a bunch of videos from them so you guys don't have to, which explains how they're thinking about investing currently and what recommendations they have for investors right now. I'm going to quickly explain what they're saying in these videos and how you guys can invest based upon that. They say that currently today, bonds offer very low interest rates and they have less advantages that they've had in the past. And today, with potential inflation in the future and very low interest rates, you'll actually be losing money and having negative real returns by investing in normal bonds that yield less than 1% when inflation could potentially be above 1%, meaning that your returns after inflation are really negative. The only real benefit of bonds now is that it is a diversifier for stocks, meaning that if stocks go down, bonds potentially keep their value or go up. Equities, which are also known as stocks, are a very important asset allocation, but most portfolios are way too concentrated on equities anyway. The most important thing to do, according to Bridgewater, is to diversify and know how to diversify well. What that essentially means is that you want to be investing in multiple countries with multiple currencies and with multiple asset allocations in these countries. In the videos with Bridgewater, they also talk about a tripolar world. The three major contributors to the global economy are the US, the European Union, and China. These are the three big regions and entities that contribute very similar amounts to global outputs. And what a lot of people actually have is they have a large portion of their portfolio with a high concentration in the US. So what they are saying is that you want to spread your portfolio across these different countries. So yes, you do want to have an allocation to the US, but you also want to have an allocation to the international developed world outside of the US, such as the European Union, as well as China, and some emerging markets potentially. To summarize, throughout these videos, Bridgewater's philosophy and what they recommend for us as individual investors is to be diversified so you're prepared for a bunch of different situations. You want to have gold in case there's huge inflation in the economy or the economy slows down. You want to have tips or inflation-linked bonds, which do well when inflation rises. You want to potentially have Chinese bonds or international bonds, so you're diversified across a bunch of different global economies. You might potentially want to have emerging market equities, which you would do using an emerging market ETF. But just to drive this home, what you want to do is have multiple countries, multiple currencies, and multiple asset classes. That is how you diversify well, and that is what Ray Dalio says is the most important thing for us to do currently. Now what we can do is we can look what Bridgewater has done in the last quarter from February to June. And what I've done here on this spreadsheet is I've looked at their quarter 1 of 2020 13F, and then I've looked at their quarter 2 of 2020 13F, which came out in around August 15th. And I've compared the two and seen the changes that he's made in the portion of their portfolio that is disclosed and that they have to report. And these changes can give us a good insight into what Bridgewater is thinking. Just to give you guys a bit of information, the total holdings that are disclosed by Bridgewater in their 13F is only around $5 billion. However, their whole portfolio and the whole amount of money that they manage is actually $160 billion. And I think the reason why they don't have to disclose all their holdings is because they are managing money for other institutions and investment funds, and I don't think that is something that they have to disclose. So it is just something to keep in mind. We only have $5 billion out of the $160 billion, so the changes that they make here, they can give us some information. It is a good idea to keep it with a grain of salt because they do have such a large portion of their portfolio that we are not actually able to see. The top 20 holdings in Bridgewater's portfolio make up around 90% of their total portfolio, so we can get most of the information by just looking at these top 20 holdings. I will leave a link to this spreadsheet in the description so you guys can go through it and look at the changes from quarter 1 of 2020 to quarter 2 of 2020. And if you want to go in more in depth, you can use that, because I'm not going to actually explain all the different changes. I'm just going to show you guys their main changes that they've made and the most important things. Previously, Bridgewater had around 5% of their portfolio in treasury bonds, and they've got rid of this by 100%, so now they no longer hold these treasury bonds. They also greatly reduced their corporate bonds in their portfolio, and also they've greatly reduced their exposure to emerging markets. One emerging market, however, that they increased their exposure to is China. They greatly increased their holdings in China by buying more Chinese ETFs as well as individual Chinese companies. For example, Alibaba now makes up around 3.4% of the total Bridgewater portfolio. They also greatly increased their positions in the US market by using S&P 500 ETFs. The S&P 500 ETFs in their portfolio now make up around 35% of their total portfolio, and in Q1 this was only 25%. Bridgewater also increased their allocation to internationally developed economies outside of the US. It now is around 7% of their portfolio, and previously it was only 5%. One of the other important changes that Bridgewater has made is that they greatly increased their allocation to gold. Previously they had only 15% in gold ETFs, and now they have around 20% in gold ETFs. If after watching this video you really like the approach that Bridgewater takes and you wanted to create a portfolio that would follow the same principles, your portfolio could look something like this. You would have an allocation to gold, an allocation to inflation-linked bonds, an allocation to China, an allocation to emerging markets, an allocation to internationally developed markets, an allocation to US, and finally an allocation to bonds. The original and more conservative all-weather portfolio would look something like this, where you have 30% allocation to stocks, 55% allocation to bonds, and then 15% allocation to gold and other commodities. You can, however, become more aggressive by increasing your allocation to stocks. So a more aggressive portfolio could look like 50% stocks, 25% gold, and 25% bonds. And an even more aggressive portfolio would have around 70% stocks, 15% bonds, and 15% gold. The most aggressive option for a portfolio would just be 100% stocks, but then that, however, does not follow the same principles that Bridgewater uses in their all-weather portfolio. And within the stock allocation of your portfolio, you'd want to further diversify by including multiple regions. So you could have 40% US, 25% China, 25% EU, and then 10% emerging markets, for example. Now that you understand the way Bridgewater invests and you wanted to actually implement this portfolio and use ETFs, I'd highly recommend checking out my other video, How to Build an ETF Portfolio. In that video, I show you how to find ETFs that you want for your portfolio. And if you've made it this far into the video, I really appreciate you. Thank you so much. Let me know in the comment section down below, and I'll see you guys next time.